Hello everyone, this is Kaustav Bishwas. Today in the frequently asked question series we will discuss on how do we allocate savings to asset class? Allocating savings to different asset classes is crucial for building a diversified investment portfolio that balances risk and reward according to individual financial goals, time horizon, and risk tolerance. Here's a detailed explanation of how to approach this. 1. Understand asset classes. Stocks, equities, shares of companies, representing ownership. They offer high growth potential but come with higher volatility. Bonds, fixed income, debt securities issued by governments or corporations, typically providing regular interest payments and lower risk than stocks. Cash and cash equivalents, savings accounts, money market funds, or treasury bills that offer liquidity and low risk but lower returns. Real estate, physical properties or real estate investment trusts, REITs, that generate rental income or appreciate over time. Commodities, physical goods like gold, oil, or agricultural products that can hedge against inflation. Alternative investments, hedge funds, private equity, or cryptocurrencies, often with higher risk and potential for higher returns. 2. Determine risk tolerance. Conservative, prefer stability and are less comfortable with market fluctuations. Typically, they allocate more to bonds and cash. Moderate, comfortable with some risk and volatility. A balanced mix of stocks and bonds is common. Aggressive, willing to take on more risk for the potential of higher returns. They allocate a larger portion to stocks and alternative investments. 3. Set investment goals. Short-term goals, 0 to 5 years, focus on liquidity and capital preservation. Savings should be in cash or short-term bonds. Medium-term goals, 5 to 10 years, a mix of bonds and stocks for moderate growth with reduced risk. Long-term goals, 10 plus years, heavier allocation to stocks and real estate for maximum growth potential, with less in bonds and cash. 4. Diversification strategy. Diversification helps spread risk across different asset classes and sectors. Example allocation, conservative 70% bonds, 20% stocks, 10% cash. Moderate 50% stocks, 40% bonds, 10% cash. Aggressive 80% stocks, 15% bonds, 5% cash. 5. Rebalancing the portfolio. Regularly review and adjust allocations to stay aligned with your target strategy, especially if market movements cause shifts in asset proportions. Example, if stocks outperform and now represent 70% of a portfolio intended to be 60% stocks, sell some stocks and buy more bonds to rebalance. 6. Consider age-based allocation, life cycle approach. Younger individuals can afford a higher allocation to stocks because they have more time to recover from downturns. Near or in retirement, should shift to more conservative allocations, increasing bonds and cash to preserve capital. If managing allocations feels overwhelming, working with a financial professional or mutual fund distributor can help create and manage an allocation strategy tailored to specific needs and goals. This structured approach ensures a thoughtful and strategic allocation of savings across asset classes. This is only one knowledge sharing effort based on my understanding. Please don't take any financial decision based on this content. Here I am not giving any financial advice. For financial advice, you should contact your financial advisor.